The IRS has finally published the 2026 plan limits for health savings accounts and high deductible health plans, and there's some big changes coming for employers and employees alike. Hey guys, what's going on? This is John Coleman, your host of Friends with Your Benefits. Today we'll go over specifically what a health savings account, also known as an HSA, is, why it needs to be paired directly with a high deductible health plan, and in addition, we will discuss how the health savings accounts compares to other savings vehicles available in the marketplace, including a comparison to the 401k and Roth IRA. And lastly, we will close out with what the 2026 plan limits are for both the HSA and the high deductible health plan. Stay tuned, you're not going to want to miss this. So now let's go into what an HSA, also known as a health savings account, actually is. So simply put, an HSA is a savings vehicle that allows you to pre-fund and save for your healthcare expenses on a pre-tax basis. It's been argued that the HSA is the singular most tax-efficient vehicle that's available to the American public. So what do we mean by that, John? Well, the HSA has what is known as the triple tax advantage. Money that you or your employer puts into an HSA goes into the HSA on a pre-tax basis and is totally exempt from federal income taxes, FICA taxes, and state taxes from 48 states. Sorry, California and New Jersey. Unfortunately, those particular states will tax the money that goes into your HSA. From there, the money in the HSA earns interest tax-free, and it can totally be invested in a variety of stocks, bonds, mutual funds, pretty much the investment options of your choice, and it also comes out tax-free, assuming you use it for a qualified healthcare expense. Unfortunately, cosmetic procedures such as lip injections do not count, and money used for that would definitely incur a tax penalty. So now let's compare an HSA to a 401k. Similar to an HSA, a 401k, the money goes in on a pre-tax basis, earns interest on a pre-tax basis, but unlike an HSA, when it's time to take money out, you'll actually pay taxes on it. Now, with an HSA, you can take money out at any time, assuming it's for a qualified healthcare expense, but with a 401k, if you take it out prior to 59 and a half, you'll definitely incur some tax penalties. Now, let's compare the Roth IRA to the HSA. So, unlike the HSA, money goes into the Roth IRA on a post-tax basis. It does earn interest tax-free, and any money that comes out after 59 and a half for any investment earnings is definitely not subject to income taxes whatsoever. Let's go back to our HSA example. So with the HSA, money goes in on a pre-tax basis and money comes out tax-free, assuming it's used for a qualified healthcare expense. So what are some examples of a qualified healthcare expense? So a few examples may include going to the dentist, seeing your doctor for routine treatment, perhaps paying an out-of-pocket bill for surgical procedures, picking up a prescription drug, or perhaps you see the optometrist and you have some out-of-pocket costs. Those are all examples of qualified healthcare expenses. So does the HSA sound too good to be true? Well, there's definitely a few strings and a few details that you need to know about before you actually decide to open an HSA. In order to be eligible to put money into an HSA, you need to have a qualified high deductible health plan, also known as an HDHP. For 2026, to be enrolled in a qualified high deductible health plan, you need to have a deductible that's at least $1,700 if you're only covering yourself, or if you're in single-only coverage, or if you happen to be in family coverage, which means that you're covering yourself plus at least one other person, whether it's your spouse or a child. Your deductible in that scenario needs to at least be $3,400. On top of that, the out-of-pocket maximum, or your worst-case scenario for in-network coverage, can't exceed $8,500 if you happen to be enrolled in self-only or single coverage. And if you happen to be enrolled in family coverage, your out-of-pocket limit cannot exceed $17,000 for 2026. That's definitely a lot of numbers to keep track of, but the good news is if you happen to get your health insurance through your employer, likely they will advertise whether or not the plan that you're looking to enroll in is HSA eligible or not. So a few other things that you need to know before you can determine whether or not you're eligible to contribute to an HSA. So first things first, you can't be enrolled in any other non-qualified HDHP plans. That includes being enrolled in a separate PPO plan, HMO plan. That definitely makes you ineligible to contribute to an HSA. Second, you can't be enrolled in a general purpose FSA and an HSA at the same time. Ultimately, the IRS views that if you're in a general purpose FSA, you're bypassing your medical deductible, and really in the IRS's eyes, that's double dipping and makes you ineligible to contribute to an HSA. So ultimately, if your employer gives you the choice of a general purpose FSA or an HSA, you really need to take a look at all the details and make a decision just in terms of what's best for you and your family. Now, as it relates to FSAs, there's actually a little loophole out there called a limited purpose FSA. With a limited purpose FSA, you can pre-fund dental and vision expenses and simultaneously contribute to your HSA. If you want additional details on whether or not a limited purpose FSA is right for you, click the link on the screen in front of you. Lastly, unfortunately, if you're enrolled in Medicare, you cannot contribute to an HSA whatsoever, and that even includes being enrolled in Medicare Part A, which is typically free to those who turn 65. All right, it's time for the exciting part. How much money can you actually contribute to your HSA for 2024? So if you happen to be enrolled in single coverage, an individual can contribute $4,400. And if you happen to be enrolled in family coverage, you can contribute $8,750 for 2026. Here's a special savings tip. So let's say you're over the age of 55. If you're over the age of 55, the IRS allows you to contribute an additional $1,000 to your HSA. If you happen to be age 55 or older and you enroll in single coverage, you can contribute an additional $1,000 to your HSA, or $5,400. Now, if you happen to be enrolled in family coverage, again, you can contribute an additional $1,000, but instead of being $8,750 as the maximum contribution, it's $9,750 for 2026. But if you and your spouse are both over the age of 55 and you both have separate HSAs, you can in total contribute $10,750 into your HSAs. And note that this is the total family contribution possible. So we want to hear from you guys. Do you have any experience actually enrolling in a high deductible health plan or an HSA? And what was the overall experience like? Comment below.